Well, clearly the evidence that we've seen so far is very encouraging. The unemployment rate is low, inflation is fairly benign, and the Fed is fairly accommodative. What we see coming out of earnings season is very encouraging as well. First quarter earnings season showed that revenues were very strong across the board for the S&P 500 companies that have reported. More importantly, as we take a look at a year-on-year growth rate for revenues, that's very encouraging, and the percent that beat expectations were above historical averages. As we take a look at the earnings for the same companies in the S&P 500, we also see that the corporate footing that we have in the U.S. is very strong. The fact that we're getting double-digit growth is very encouraging. That's the first time that we've seen double-digit growth since 2011. And in fact, over 82% of the companies that have reported in the S&P 500 have exceeded or met expectations. That's very important because that exceeds historical averages, and also on a trailing four-quarter basis or trailing 1 year, that also exceeds that average as well. So that's very encouraging for the back half of 2017. First quarter earnings have been very encouraging and very supportive of a continuation of some of the strength that we saw. On the top line, companies are earning more than expected. And for the back half, many of the companies, technology, consumer discretionary, even industrials, have indicated a better than expectation than what they had a quarter ago. From an earnings standpoint, they would also concur that potentially there's a back half continuation of the strength that we witnessed. In fact, if we bake in any of the presidential agenda issues, i.e. repatriation or tax reform or deregulation, some of this could further support and be a powerful tailwind to the back half of the year. It's true that the S&P 500 next 12-month PE ratio is above the historical average. However, coming out of earnings season, there's a lot of affirmation of the strength of the U.S. economy and U.S. corporate America. In fact, as we take a look at the back half of the year and project into 2018, the potential for upward earnings revisions should help alleviate any type of PE risk that many of the marketplace has put into concern, or the overvaluation of the U.S. marketplace. Currently, the bottom-up S&P earnings for 2017 is about $131 per share. As we come out of earnings season, the back half could show continued strength of revenue as well as earnings. But then as we look forward to 2018, the dollar per share is about $149. Those are base case numbers. If we were to receive any type of tailwind from some of the Trump agenda, that could be deregulation or a change in corporate tax policy, that could prove to be a very powerful push from behind to make those earnings improve even better. That's very encouraging. So that should eliminate some of the fears or concerns. But historically, as we take a look at PE ratios only, we've seen extended periods of time, mid-2000s and mid-1990s, where we have traded above historical averages. In the current environment, we have a very strong credit environment, so there's not a lot of default risk there. As I've already mentioned, we already have a very strong earnings environment, so that's also very comforting and very constructive to a very positive outlook for the balance of 2017 and 2018. Well, the Fed has certainly done a very good job at telegraphing the interest rate hikes. In fact, the market is anticipating 2 more hikes for 2017. Overall, if we think about this historically, the Fed has been very accommodative and will continue to be very accommodative. But if we look across the seas, we also notice that the global effort from the central banks has been particularly accommodative as well. They are raising rates for the right reason. Unemployment is low, inflation is fairly benign, and coming out of earnings season, I think the evidence shows that corporate America is on very solid footing. As we think about the risks going forward as the Fed raises rates, I think our clients should be concerned about their fixed income U.S. corporate investment grade investments. In fact, as rates start to back up, we should help advise our clients that those assets in the client portfolios can certainly be at risk. There are other asset classes that are a little bit more immune to when rates back up. A lot of the strategies that we manage, convertible bonds, high yield bonds, as well as large cap equities, are fairly inversely correlated to a rising interest rate environment. They've proven historically to be very good investments in those kind of environments.
Allianz Global Investors. Understand, act.